Here at Gen Wealth Financial Advisors, we're always keeping you up to date on what's going on with your retirement, your investments, and your money. And because we've had such a bad start to 2022 in the equity markets and in the bond market, we wanted to do a little check-in over this holiday period of time with Ryan Detrick to kind of get a little bearing about where things are right now. Ryan joins us from his home in Charlotte. Ryan, great to see you and appreciate you joining us. The markets obviously, these markets have personalities almost of their own. And we've been in this pullback now since really the first of the year. And we see that the market has somewhat stabilized over the last couple of days. What are your thoughts on where we are in the journey that we're on in this pullback? And have we found bottom?
Yeah, John, thank you for having me back. But we think we're pretty close. Is it the bottom? Well, maybe, maybe not, but we're pretty darn close. I want to put it like this, right? Hopefully most listeners know it. The definition of a bear market is a 20% correction. NASDAQ's been pulled, that has had that. Small caps, lots of different areas are in bear markets. The S&P flirted with it. You go back, John, like a long time, like 50 years, all right? We've had a bunch of times we get right to about 19% if you're not in a recession, which we don't think we're in a recession. This market pulled back 19%. 1978, 1998, 2011, and 2018 all were years where the S&P pulled back 19%, and we were not in a recession. It is very rough what has happened so far this year, no question about it. But overall, I know we're going to talk about the economy here in a minute, I think. The economy, we don't see a recession. Maybe we're pretty darn close to a pretty good sized low, which hopefully have a lot of investors smiling, this time 6 months.
We certainly hope so. And this has been one of those unusual times when obviously the stock market is down, but we've also had, for the first time in a long time, a pullback in the bond market as well. And that has rattled a few conservative investors. But I think if I understand your thoughts about this, bond market might be looking like it's stabilizing as well.
Yeah, that's right, John. I mean, this has been one of the worst starts to a year ever for stocks, but also one of the worst starts to a year ever for bonds, which is obviously tough given most investors have a little bit of both. But again, we talk about stocks maybe close to a bottom. We think bonds really do offer some opportunity here. I mean, you keep this simple. The 10-year yield went up to like 3.25% just a couple weeks ago from half of that this time a year ago. And again, that's pretty extreme, okay? And all the talk about inflation expectations and the Fed hiking, all this stuff, the market kind of prices a lot of this stuff in. Our take, John, is if inflation starts coming down a little bit more than expected, our base case, these yields can start coming down. And most listeners of the show know when yields go up, bonds don't do as well. But when yields go down, bonds can do better. We think yields are going to start to work their way lower here as inflation expectations come back down to earth. And that should be a nice opportunity for bonds. And one more quick one. Like you said, the first 4.5 months of this year, 5 months of this year, bonds and stocks both went down. All of a sudden, the last couple of weeks, we've seen stocks still kind of take it on the chin. We have had bounced lately. But what we saw the last couple of weeks is bonds started acting like bonds, started giving you that diversification and safety that they normally do. So we're pretty optimistic that we're going to get back to more normal times going forward with stocks and bonds.
And I heard you guys say just the other day that you may be, if you're thinking about pulling out of bonds because you've had such a bad time, that might be a mistake. That's probably one of the most blatant statements that I've ever heard from the research department of telling folks, hey, look, stay put where you are.
Yeah, the truth is this. If you chase the shiny object 6 to 12 months from now, it's probably not going to be the best performer, right? What we're hearing a lot of, look at commodities. I mean, commodities had a great run. We've talked about commodities before. So a little commodity exposure makes sense. But now we're hearing people say, I want to get out of my bonds and get into commodities. Well, listen, after the run we've seen, of course, that's what you want to do. But history would tell you that's probably not the best way to do it. So stay diversified, continue to follow your plan. And again, bonds are probably going to have some people smiling again 6 months from now that haven't been smiling at all to start this year.
So let's go back to the economy for a second, and because I'm running a little bit of a thesis here, and I think that the CEO of Cisco, Chuck Robbins, actually agreed with me on CNBC the other day that the fact that we're talking so much about a recession may be a self-fulfilling prophecy. I wonder if you might think that might be a possibility that we could be talking our way into a recession.
First off, is he a listener to the show? Because very well, maybe he heard what you've been saying.
He's a way smarter guy than I am. I can tell you that.
There you go. But I'll tell you that that's not our base case, John, but it is possible. I mean, you turn on the TV and you hear different things. I mean, just people you talk to, maybe we're not going to take that vacation now because prices are higher and some of the concerns that are out there. So we've got about a 30% chance over the next 12 to 18 months of going into recession here at LPL Research. The truth is earnings season was pretty good until we got to the end. Some of those big retailers, Targets and Walmarts, it had some disappointing things to say about really the consumer and the supply chains, and those things just unfortunately aren't going away. But we're still pretty optimistic that when you look at the consumer is still spending, still getting out there. Yes, there's pulling back a little bit here, but again, the big question is this a recession or is this a mid-cycle slowdown? Historically, you can have a mid-cycle slowdown like a la 1995, and then the economy keep going higher. So we think it's more of a mid-cycle slowdown, not the start of a recession.
So in light of all of that, Ryan, tell us what your portfolio teams are doing right now. What moves are they making to prepare for the next 6 months, the future that you guys see?
Yeah, I mean, some of the easiest things people can do is stay the course, right? Stick with stocks and bonds. And our take, though, a little more specific here, we're actually kind of evening up growth value, right? We see opportunities on both sides. On value, some of your energy and materials, some of the things that got you here are still nice. But I'll tell you, technology's been hit really hard. And we think there could be some opportunity there the second half of this year as kind of yields start to go a little bit lower. So those two groups, or those a couple groups you like on fixed income. We think high yield bonds to us look a little bit better right now. If you're not going to recession, there's again, like the name suggests, a little bit of yield, but a little bit more appreciation on the high yield side of things. I think the most important thing for investors to remember, though, is to stay the course. Do not panic. I'll leave you with this, John. Let's leave you on some good news, right? We just had the 100th day of the year earlier this week. This was like the worst start to a year since 1970 for stocks. If you look, though, at the 5 worst starts to a year ever, the rest of the year after day 100, up every single time, up 19% on average. This was the 4th worst start to a year ever. So that's just one data piece. I get it. But let's leave on some positive news that, hey, maybe we can follow the lead some of those other bad years that had pretty good endings.
Absolutely. Ryan, always a pleasure for you to be here. And for our listeners and viewers on social media, if you have questions, reach out to your advisor here at Gen Wealth. Give us a call. We'd be more than happy to visit with you. And if you're not a client of Gen Wealth and have heard some things that you might be interested in talking about, we would certainly love to visit with you as well. Go to getreadyforthefuture.com and contact us that way. We'd be glad to visit with you.